But if the government does do the right thing, it will default because there's no way to repay. So default is the only honest way out of this mess. But most people think that there's no chance that the U.S. government will ever do the right thing. And so they think they're just going to print. And they think because the U.S. government can print as much money as it wants, well, then it never has to default. And therefore, U.S. Treasuries should be rated AAA. But when you are rating a sovereign that borrows in its own currency, right, you are not supposed to be looking at default. You can assume that the risk of default is zero. What you have to look at when you are rating sovereigns that borrow in their own currency is the future value of that currency. So the rating is not on the bond, but the rating is on the currency that the bond is denominated in and that the lender will be repaid in. You see, not being repaid and being repaid with worthless money are the same thing. And if the U.S. government were to do a restructuring and pay off 50 cents on the dollar, right, everybody would say, oh, that's a huge default. If there was a significant risk that the U.S. government might only pay back 50 cents on the dollar, right, S&P, Moody's, Fitch would all substantially reduce their rating on U.S. Treasuries. Clearly, they're not risk-free if you're going to lose half your money. Well, it's the same thing if the dollar loses half its value and you get paid with money that buys half as much as the money you loaned. And in fact, nowhere is that more obvious than to our international creditors who need to look at the exchange rate between the U.S. dollar and their own currency. If I'm in Europe and I lend somebody U.S. dollars, I have to take my euros and buy the dollars. And in 10 years, when I get paid back dollars and have to rebuy the euros, if I can only buy back half as many euros as I sold to make the loan, I've lost half my money. So I arrived at the same destination, regardless of how the government got me there, whether it was through default or through inflation. So what the rating agencies are supposed to be looking at when they decide what rating to put on U.S. Treasuries is, will the U.S. Treasury be able to repay this debt honestly by raising taxes on American taxpayers or reducing government spending on things like Social Security, Medicare, Obamacare, pensions, all that, so that they can honestly free up the money to repay the creditors? Or does the U.S. government have so much debt and lack the political courage to cut spending or raise taxes or even the ability to do it because the American public is too broke to afford the higher taxes? And therefore, will the U.S. government have to resort to a printing press to repay the debt? And the answer to that is obvious. Of course we will. We've already resorted to a printing press right now. The Fed is printing trillions and trillions of dollars right now. If it wasn't, we couldn't meet the obligations on the existing debt, let alone repay it or meet the obligations on additional debt. So clearly, if Standard & Poor's, Moody's, or Fitch were being honest about the outlook for the U.S. dollar, they would, cut the rating on U.S. Treasuries right now. Because there's no way anybody who buys a U.S. Treasury for 10-year maturity or 30-year maturity, even worse, if you hold that bond to maturity, there is no way you're going to get your purchasing power back. There is no way you are going to be whole. And the little teeny bit of interest that you get, at 1% or 0.5% or whatever it is, that tiny bit of interest will be insignificant compared to the purchasing power that you lose for holding that bond to maturity. So the whole thing is ridiculous. These bonds are junk. They are more junk than the subprime mortgages that were junk, but that were rated investment grade.